I don't know about you guys, but this has so far been a great morning. I've really enjoyed every single presentation we've had so far. And we're going to finish it off with what it looks to be a really great panel. So I'm going to introduce the moderator, and then he'll introduce the people on the panel. So the official stuff, basically, is that Daryan Dehghanpisheh is at Intel. He is Global Director of Financial Services. The interesting two-side things are, number one, that he has been in over 100 different countries. I assume much of that is for his job, but for other reasons. But he claims that the main purpose for going to all these countries is his search, his ongoing, everlasting search for unique, great food. He may have something to say on that a little bit later. Secondly, and I love this, being an educator, I love this part, he really believes strongly in the power of education, and what he does is he volunteers in charter schools, not just giving them support and money and things like that, but actually teaching kids in these charter schools stuff related to quantitative education. The last thing is I haven't done a totally exhaustive search, but I believe that Daryan uses more letters in his name than any other speaker at the conference. So without further ado, let me introduce Daryan Dehghanpisheh.
Thank you, Michael. So we're going to take a slightly different tact with our panel today. Our panelists primarily are very active market participants in a range of ways. But we really want to talk more about the technology implications behind what's happening in the business side. And so with that, I want to go ahead and introduce the four panelists. Arzhang Kamarei is the president and partner of Tradeworx, Inc. So feel free to come on up, gentlemen, as we call you out. John Goode is the CIO of the Boston Options Exchange. John Page is managing director of On Trading. And Larry Pitcher is the managing partner of QUANTORITHMS Fund. Thanks. Sorry. So I guess I wanted to start off by saying that in one of the earlier presentations, actually the kickoff presentation from Blair, he mentioned the notion of the cost of getting into the business. And the first question will go to Arzhang.
Okay. 1, 2.
He put a slide up in a figure that had a $200,000 to $250,000 range of kind of being the barrier, if you will, to getting in the game. You think that's accurate? And if so, a question to the follow-up, coming back to then Larry and then working back. Have those costs risen or fallen? And what's the role of technology's impact in the cost structure?
Yeah, I think that those numbers are accurate if you're actually trying to build a firm where you'll be growing the enterprise value, and you're not doing a work out of your garage. You're an independent trader type of operation. In terms of barriers to entry, I think they've been changing. I think that the technology barrier to entry has in fact gone down, not because it's become less competitive or the technology's become less advanced, but simply because there's so many other places that you can get the technology. You don't have to build it all in-house. I mean, there was a time that you couldn't get rack space at NASDAQ. Those days have definitely ended. So with the proliferation of third-party vendors making it easier and easier to get technology, I think that that, in fact, has gotten to be easier. On the other hand, I think the barriers to entry have certainly increased in terms of the competition. It's certainly much, much harder to make money in high-frequency trading now than it was a while ago, and I think that's why you're seeing increasingly firms struggling to make money and looking at other ways of diversifying their business and incorporating more alpha, pushing out to less efficient asset classes or less efficient geographies.
Yep. Go ahead.
Okay. Larry Pitcher, QUANTORITHMS Fund.
let me precurse it with, I run the FX division, so I'm more medium frequency. I may not be at these guys' level for the high frequency, as one of my partners that was not able to attend. From a spend side, I think that, yes, the rack space, colo, the connections is not that expensive. However, if you want to run high-tier CEP, you don't want to build it yourself. You could look at Streamworks for around $800,000 a year. You could look at Arzhang's firm, where you can get into leasing, monthly leasing of the softwares, probably $25,000 per server, so around $50,000 per exchange that you want to trade into if you're doing market making and rebate seeking.
Yeah, I would agree with that, John. Good Boston Options Exchange. I would agree with that. So certain aspects of the technology have gotten dirt cheap over the years, right? So what we pay for servers these days and the capability of those servers is just, the capability is phenomenal. Cost is extremely cheap, right? Most of the networking stuff within your data centers, 10 gig cards, extremely cheap, right? Software, what you can do right now with software, again, the toolkits that are available, the off-the-shelf components that you can piece together to build stuff, fairly cheap. It's when you actually start looking at, like, okay, what's my trading idea? What's my strategy? How do I do the CEP, the complex event processing around it, and try to pull it all together? That's when you start incurring cost, and it starts to get more costly to do. And then you got to ask yourself, okay, what do you want your footprint to be? If I'm on a single exchange, or if I'm, let's say, doing options in the New Jersey area, and I'm just working against Mawa and Carteret and Secaucus, where the major options exchanges are, my overall technology cost might be relatively low, okay? If I'm looking at pulling in data between Chicago, New York, Toronto, Montreal, London, now all of a sudden my networking costs are just starting to go through the ceiling then. So I think there's an opportunity for people to get into it, be high-frequency traders or algorithmic traders, do it relatively inexpensively, and have a pretty good impact. But I also think that depending on what their growth patterns are, can get costly pretty quickly.
Yeah, and John Page on trading. And just finally, tools are cheap, but people are expensive and hard to find.
So a question really quick, going back to the tools element, John, which is, people are constantly talking to Intel about how to get the next, 100 microseconds out, and the next 5 microseconds, 2 microseconds, breaking the microsecond into the nanosecond barrier. Is that incremental cost worth it today?
You're asking me?
Yeah.
So for us, when we look at strategies, when we look at building businesses and rolling things out, we try and estimate what the incremental additional profit will be for some unit of speed, and so that we'll go about trying to solve that problem that way. I mean, if it's just simply not available, if we can't do it, then we can't do it. But if we can do it and we think that it's affordable, then we will. Or at least that's for us how we try and resolve that problem.
And John, good to you.
There's a natural limit, based on the speed of light and all that high school physics we all forgot. Down around, I would say, 50 or 100 microseconds when it comes to tick-to-trade execution for a co-located facility. We're all going to be there shortly. Whether it's this year or next year, we're all going to be there. It's going to be driven by execution quality, controlling slippage. So yeah, I think we'll all be there, and the cost in doing it will get cheaper and cheaper. The next thing after that is when you're looking at driving alpha, I think it really all depends on your models and what's your trading strategy, and less over time on just what the speed is. The speed is your base cost of doing business, and that's the way we look at it at Box.
I would agree with that. I think that what's really important is as the arms race continues and as people's differences between their speed compresses, then just the natural variance in the systems that you're trading on will start to determine who's first at a certain point. And so, yes, it becomes increasingly harder to make an investment just to eke out a couple microseconds. I think the other thing that's important is the latency advantage that you're trying to get something that's an actual edge for you, or is it just a cost of doing business? Now, if you consider the case of the spread line that went up, a lot of people spent an awful lot of money to just be on a level playing field, and I think you'd be hard-pressed to find a firm that made a lot of money just because they went on the spread line. So that, for those category of latency costs where it's really just a tax, and you might be seeing, some tiered offerings from exchanges that effectively try to replicate this model, which is you have to pay up to be on the same level playing field. Those are all going to be expenses that HFT firms are going to be very, unhappy about having to spend too much money on, because it really doesn't add anything to your alpha.
And Larry, any comments from your point of view on this?
I think most people in this audience are not going to be top of book. We're not going to spend $20, $30, $40 million a year on this, so you're not going to, your latency is more on making your decision, not how fast your execution. And the execution is going to be just, you're not going to be able to do it. So if you're not at that level where you have a $20 to $40 million budget to be in with one of the top 5 market-making firms on a UHFT level, you're not going to be top of book. You're not going to be 5 microseconds. You're going to be closer to 50, which is very competitive. You can make money at 50 microseconds.
So that brings up an interesting transition, right? It's the cost of decision and the speed of decision making. One of the things that Matt Shapiro talked about earlier was this notion of data and the chaos mathematical theory that he talked about, and the amount of data sets that fold back on themselves, and the amount of data set sizes that would actually be needed to necessarily calculate that. And I guess this question, starting with John Goode, the industry's buzzword du jour seems to be big data. And the role of big data, I can see how that would, play into some of the conversations we've been talking about. But from your point of view, when does big data as a technology or a technical tool start to make a big difference?
And I think that's one of the challenges we're going through right now. It's like, how do we wrap our minds around big data and make it something that's usable? When you look at the exchanges, every exchange out there has the ability to generate millions of price updates per second. Box, for instance, will generate, on every opening of every morning, will be between 1 million and 2 million messages per second. And we'll do that throughout the day, generating probably, a billion quotes a day for 5% market share. And so we're all kind of like in this big data challenge, and it's really, and people are just beginning to wrap their minds around, okay, what do I do with this, right? The traditional technologies that we've used around relational databases and storage like that don't work with big data. And it's like, I don't think I've seen a firm, even when it comes to pure time series data, be able to do the research that most of the quant groups did, let's say 5 years ago, just because the data streams are so large. So that's one of the challenges that we're having. And then you couple that up with non-traditional data. So big data is a problem for the trading markets. Big data is an even bigger problem for the internet. So when you're looking at non-traditional indicators and triggers of where the market's going and how to put your finger on irrational exuberance so you can predict where the market's going to go intraday, that big data problem becomes even more of a challenge. And it's like when you look at how the firms currently are going about it, they're using a variety of techniques and technologies. A lot of it's based on what Google and some of the other internet companies are doing, the NoSQL databases that are Hadoop and some of these others. But there hasn't been anybody, I think, that I've seen who's actually made a huge breakthrough and has traded consistently off of big data, both traditional and non-traditional.
Over to you, John.
Yeah, I mean, I'm not sure what I want to say about big data. For the most part, if there's an enormous amount of information out there, what you should know in advance what you're going to use in order to make your trading decision. The more you can use, or let's say the information that adds some incremental positive to the decision that you're making is something that you should try and incorporate. But if you're using a data set that's so big that it folds in on itself and you can't do math, I'd suggest not doing that.
One of the, just as an anecdotal comment to all this, one of the good friends of mine who runs an HFT firm, we were having a conversation around, testing, right? How do you pull all the data in together and use R or Mathematica or MATLAB and be able to back test your models on? And and his comment with a chuckle was they've actually moved away from that. And they look at building their models on a very small set of data, and then they just trade one lots and tune them on top of that. So it was definitely, non-traditional. And when I asked him why, it's like, well, data's too large, can't wrap our arms around it. We'll find an area of interest, a certain set of names, instruments, or whatever. We'll come up with a trading idea. We'll do a limited amount of research on it. We'll start trading one lots against it with the algorithm, tune it in from that, and then there's a tuning process with one lots as they move it around and expand into other areas. So definitely a different approach, and one that's driven by the inability to cope with big data.
Or fast data analytics to look at how you structure on the currency side, some of the capabilities. Are you using them? If not, what's the major prevention there?
Going towards sentiment, we're looking at that, but as far as the big data sets, I'm acutely aware of that because we're going into other asset classes and instruments. And on a tick level, you're talking almost 2 gigabytes of data a day. And then it's more, I think the audience would be concerned with write versus memory. If you're writing it, you have the persistency to use it later. Do you want to then retest something? What did it do live and what did it do, changing little tweaks to your model? But if you're using in memory, you can process a lot faster and you can do a little bit more with it, but you're not going to save it. So to answer your question, yes.
Sorry.
Yes, I'm aware of both. We are looking at other things.
Arzhang, any comment?
The size of data sets hasn't prevented us from being able to do any of the things that we've wanted to do in terms of how we typically approach trading, backtesting, this sort of thing. There's certainly solutions and tools for simulations and using Amazon's cloud, for instance, that have been fantastic for us and have let us do a lot with big data. In terms of how that affects ultra low latency trading, though, that's not really the problem we have when you're looking at a latency issue, because when you get down to it, the trades that trade the fastest are the ones that are structurally related. So, for instance, SPY moves, and you want to see what happened to the futures, or vice versa, or the components, and that's not really a enormously complex calculation. So there, you're using a different type of set of techniques to deal with processing data quickly, and you're parallelizing. But in terms of when you start to deal with big data sets, well, that's when you start to move to more statistical correlations, and then you have a lot more time to put on those trades because they're persistent. They actually have to get to a big enough spread to actually make them worthwhile to put on, because you're only statistically likely to make money off that. And so it's certainly an interesting area, but we haven't seen it affect any of the ultra low latency trading that is in the market.
Yeah, at Intel, we've been working a lot with stat arb firms as they look across that, and what we're noticing is that as they implement their fast analytics, one of the things that they're doing is their hold times are coming down considerably from what they used to be. So we're seeing the hold times on stat arb firms in terms of the positions they take shrink radically as their technology steps up, so they can take advantage of that. Did you want to any final comments or thoughts? So, we started out talking about speed, and then the notion of, we talk a lot about big data as a function of smart, how it helps you see the world a little more capably. And I'd actually like to start with you, Larry, on this question, which is, when it comes down to the balance of speed versus smart, a lot of it is around, the technical talent of what you're able to do and finding good technical talent. And I guess, my question is kind of this. Where's the balance for you guys right now in terms of what you're looking for as you seek out technical talent? And by that I mean, what are the real critical skills that are needed of planning for tomorrow while also being able to run your business today as you try to implement and search for that talent?
Are we going back to the trader versus quant question?
Perhaps.
That always comes up.
Perhaps. It's not really so much a trader versus quant. I think the underpinnings of the markets and the underpinnings of almost any trading strategy now have so much technology influence in some form or capacity. In that current state, you have to be looking for everything from programmers to modelers to traders who actually understand how to communicate in that language and utilize the tools that are being given to them. How do you see the search for talent going right now?
I see it every day. We're barraged with resumes coming from the Citadels, the Goldmans out there, and they are not happy. You know, February 1st, they didn't get their bonuses, and those bonuses were discretionary, and all of a sudden their $20,000 a month base salary is nothing without the bonuses. So we have a lot of guys that are coming to us, and we are biased towards programming, analytic background, as opposed to the traders. So we want traders, but we want quants that can speak the right language. And we want to bring in and you know, get the best guys out there so we can come into all of the other asset classes and instruments, let alone the exchanges around the world.
And John Page, from your perspective at your shop, how are you seeing the search for talent and any issues or hurdles that you're finding there?
Well, we're a pretty small shop, and we've got and we actually don't have the firepower to meet Blair Hell's budget, so we have to solve those problems in a different way. And the way we do it, we don't need any more dusty old traders. We've got enough of those, and so we. But since we're small, and we try and we're pretty agnostic as to what sort of alphas we'll go after on the sort of speed smart spectrum. We look for people who have basic technical grounding. You have to be able to do the things that you all know that you need to be able to do. But we want people who are also smart and just generally good, smart, flexible, and good problem solvers. And that's just a high quality person, and high quality people are always rare and valuable. So so when we find one, we try and make sure that we incentivize them well and make them happy to stay. But you have to talk to a lot of people to come across those sorts of qualities.
John, good from a technical perspective and a technology perspective as a CIO. You know, what skills are you seeing, if any, that are lacking, and where are you seeing an oversupply, if you will?
Gee, I don't know if there's an oversupply at all when it comes to technical skills. But, you know, some of the things that, again, getting back to the big data piece, again, you know, people who are coming out of school or recent graduates, you know, they don't necessarily have the experience with working with large data and having to think out of the box around it. So I guess that's one area where I think we could see some improvement. And then just to throw a little bit different perspective on all this, you know, 10 years ago, it's like if you were a top-notch graduate from any one of the good schools, a Big Ten school or Stanford or MIT or whatever, insert your own favorite school there, please. You know, you would get courted by, you know, all the financial services firms, the Goldmans, the Merrills, the Morgans, Lehman Brothers, et cetera. And the other competition would be coming from the big consulting firms. And you would pick which sort of lifestyle you wanted to lead and which sort of problems you wanted to solve, and that's the direction you went in as a technical person if you were a top-notch graduate. And, you know, the change that's going on right now, it's like these internet companies are the third competition out there. So if you've spent your life on Facebook, on Google, and a rite of passage and a bragging right is your score on the Google test that they do every year on campus, right? When you go out there, you know, that's our big competition right now when it comes to finding the best coming out of school. And you know, we're kind of a traditionally different community. We're a little bit more quiet, reserved, secretive. Chinese walls between all the divisions of our companies, right? And it's like the kids these days want to graduate from school, you know, go to Google, you know, go to Facebook, tweet with Zuckerberg all day long, right? And, you know, and quite frankly, even on the financial side, it's like when they hit an IPO, they've probably done better than a lot of us would do, you know, with the financial services firm. So that's just kind of a bizarre little twist to the perspective.
And from a technical perspective, as you hunt for technologists to support you, are there skills gaps that you're seeing between what your infrastructure is currently and where the universities are educating students and bringing them up? For example, at Intel, it's impossible for me to try to go find somebody out of college right now that's going to know how to do an Oracle DBA, but I can find all kinds of people that know how to use, you know, file chaining and other things to create data sets.
Well, and even it's like typically the best people you're looking for are the ones that are going to have, they're going to come out of it not only with the education, the formal education, but it's going to be a hobby and a lifelong passion on the technology side too. So they'll be, you know, well-versed with open source. They'll be well-versed with Linux. the databases that are available to it. It's kind of interesting, too, the shift in technology over time. A lot of what we do to build our systems, we're stealing from the supercomputing, high-performance computing areas. We're stealing from the gaming industry. And it's like the gamers know a lot about building high-performance, Wintel-based or Intel-based systems. So I think when we go and look for the best that we can find with respect to technologists, we're looking for that passion, we're looking for that zeal, we're looking for it as a hobby and a lifestyle, and then we're looking for something that, practical experience around gaming or open source that we could leverage right away.
Arzhang, do you?
So first of all, I just want to comment that I like the fact that you call it speed versus smart, because I think there's something of a false worship of speed in a lot of these conferences that, if you're slow, you're somehow inferior to HFT traders that are faster. That's certainly not true, because if you look at historically at the financial industry, the hedge fund industry, the people that make the most money are the people that are very slow. They're human traders. They're discretionary traders. I haven't heard of any HFTs that are buying $50 million Picassos. If you look at the top 10 wealthiest hedge fund managers, there are no HFTs really up there.
Yeah, Ray Dalio's not exact. Ray Dalio and Bridgewater aren't exactly doing HFT.
Exactly. Now, in terms of finding talent, it's definitely a challenge. It was much harder a few years ago. In 2008, 2009, 2010, there was a lot of excess spending and almost a bubble mentality surrounding HFT, where people falsely thought that the volumes that were present at the time would continue. And we've certainly seen a reversal where you're definitely seeing resumes come in from other HFT firms, and they're highly qualified people that are looking for positions. That said, of all the challenges we have to deal with, finding new people is the one that I find least exciting and fun. Anytime we want to launch a new project, the idea of, like, good Lord, how are we going to find the people for this? It's always a challenge. I understand the competition from some of these, from some of the internet companies. I think it's probably, in my experience, it's been more from the emerging internet companies and the startups. We get people who are like, oh, God, I could go to Google, I could go to Facebook, but I had a friend at Google who spent 3 months working on a button. And I just feel like we are in a much more entrepreneurial space than maybe some of those bigger companies.
Got it. So, Arzhang, last but not least, you mentioned about kind of hiring to go into new businesses and new concepts, if you will. And that brings me to the question about market structures and market opportunities in the search for alpha. As you look across that, what are you seeing in terms of opportunities out there and challenges to those opportunities, whether it's investing into a new market, a new geographical market like India as a HFT firm, or whether it's about setting up some type of new HFT strategy in a different type of asset class, or bridging those two? What's the first thing that kind of goes through your mind after you said, hiring the people to get it done, as you enter into a new idea?
I think it really depends on what your skill set is and what your edge is. So at Tradeworx, we both have a high-frequency trading business where, we're trying to focus on microseconds, and we also have an asset management business, StatArb hedge fund that has a multi-day holding period. So we have experience in playing in both ends of the spectrum. We feel comfortable doing both. In terms of launching a new business, it really depends. If you are not a strong alpha shop, then you're going to be forced to try to find other HFT-like opportunities where there is a low operational cost to entry. You don't have to buy a ton of infrastructure. You don't have to spend a ton on telecom. That's absolutely the worst spend that you're forced to make, and the one you do most grudgingly. And where you feel that there's some opportunity to get into liquid securities that you can trade in and out of quickly, and where automation can provide an edge to alpha. So you're not going to be trading CDS. Some of the most liquid CDS contracts might trade 50 times a day. You can't automate that process and make it any better than a human. And it's really just it's a question of what you think your edge is and what the operational barriers are. I do see that people tend to start tend to go to the thing that's closest to the thing that they're already successful in. So if you're in equities, you might go to futures. If you're in futures, you might go to equities. You don't typically say that I'm going to go from U.S. equities to, Korean options. It's just too much of a jump. Although, if you were able to actually think that way and go to the opposite end and look at the most emerging markets, you probably end up having a pretty good business for yourself. It's just hard to pull that trigger.
Larry, sure.
You could feel me just wanting to jump in there. Okay, this will be interesting for you guys. We do two things. We're looking at organic growth vis-a-vis taking what I've done in my strategies and my alpha generation and running it, replicating it into other instruments and asset classes. But bringing in these traders, when we're interviewing guys from Golden, for example, going back one question, they have a team under them. And if they come in, did they execute? Did they write the code? Where were they in that team? I can't hire the whole team. If I bring one guy in so that we can jump into something completely different than we're already doing, but we'd like to do, whether it's here in the U.S. or in other markets, how do we put all those little pieces of the puzzle together? And I think that you guys may also run into that struggle.
I guess from my perspective, I think you need to do both. So, obviously we've all spent a lot of money building up systems, within the U.S. market, whether it's options or equities or interest rates or futures, and you need to be able to take your capabilities that you've invested in the team that you've built around it and expand into adjacencies. Where can you find alpha in things you're not doing that are similar, that would be easy to leverage, your team, your systems, et cetera. And then the next thing after that, it's like obviously when we look to South America and China and India, there's going to be huge growth opportunities over there. And the sooner we all start moving in that direction, taking our best people and moving them over there so that we can start building up shops over there, the better opportunity we'll have to be in the game long term, because 15 years from now, those markets are going to be huge.
John?
As far as sort of how we do it, so both my business partner and I have pretty varied backgrounds. I've traded most products, first as head of the exotics desk for ING out of Amsterdam, and then as a portfolio manager for Citadel. And my partner has a similar background, so we have a fair amount of experience with most of what's out there and can be traded. Then actually Arzhang, I think, described pretty well what qualities you look for within those different products and how the markets work in terms of whether or not you think you can get involved profitably. And then we do another thing which Arzhang described, which is every time you open up a new business, you're taking on a lot of risk. It's gonna take your time, your attention. Probably gonna spend some money on something. So the fewer unknowns that you encounter along that route, the better. And so that usually means a small branch off of something that you're already doing relatively effectively. The least number of changes possible is the most conservative and least risky approach.
So just wrapping up, one of the things I like to do when moderating a panel is to have the panelists ask one other panelist of their choice a question of their choice. And so I guess, John, I would like to start with you, and then we'll go to the other John next. So ask any panelist that you would like your one question.
Actually, Arzhang, I'm curious. Your firm, I thought, wrote a very intelligent response to the SEC after the flash crash with regard to what the issues are in the U.S. equity market and what some reasonable responses might be. And actually, you alluded to something earlier that is part of my question. When you're talking about sort of different tiering rates at the exchanges, and also in your paper you mentioned ISO orders in terms of overall fairness for all market participants in the equity markets, or actually I would say lack of overall fairness for all participants in the equity markets. Counter that, when you turn on your machines every day, you are, I believe actually that high frequency traders do provide some sort of utility to the equity market, so you are providing a service, and perhaps better access like exchange memberships used to provide is your due. Would you elaborate a little bit further on that? Do you think that would you continue to advocate a more fair playing field, same rebates for everybody, the elimination of ISO orders? Or do you think that there should be some advantages for certain consistent and regular participants in the markets.
Well, I mean, your question touches on a lot of things, so I'll try to jump in at a few different places and see if any of it makes sense. In terms, the last thing you said seemed to make it seem that perhaps there should be some type of different structure for market makers who might have some capabilities to send certain types of orders, have some benefits that other participants don't. In general, I think that that's probably not a good way to go because it does stifle competition. A lot of times, some of the advantages that are given are more than paying for themselves. If you see some of the biggest HFT firms actually have been supportive of having market maker obligations. So I think that the best way to approach it is to have an absolute level playing field. In terms of what we said on ISO orders and locked markets, I think that there are two issues there. The general principle is that it can be very dangerous to create regulation to fix a problem if you don't completely understand what the problem is. And Reg NMS created this world where ISO orders allow people who can send them to get around price time priority. Our proposal that we thought was a good way to address this was the allowing for locked markets, which would eliminate this, maintain price time priority, let everyone have equal footing there. And at the same time, it's a way of actually allowing something but not creating enormous amounts of regulation surrounding it. It could be tested very simply. And so, that's in general been our approach. We do think that as level of the playing field as possible would be in everyone's interests.
Larry, what question would you like to ask one of your fellow panelists here?
I'd love to ask about Ken Griffin, but I won't. Okay, sell the audience on why we should trade options in Boston. I would like to know, and I'm sure several of the audience people would.
Because we've got a great platform, great service. One of the things that's different about Box and most of the other options exchanges, we focus on the retail customer. And whether you're a hedge fund or non-professional, non-high frequency, good non-toxic flow is what we focus on. Our primary mechanism right now is our price improvement auction. So our best execution stats are fantastic. We have a solicitation and facilitation vehicle that will allow you to do size if you need to do it. We've got a core of great market makers who are willing to step up and match. And then this summer, it's like we're going to launch our complex order book. And that complex order book will launch day one with implieds from the legs to the strategies, to the spreads back to the legs. And we'll also have our various forms of our auction available at that point in time too. So I think we're a great little exchange, and you'd have a great experience trading on it. Thanks a lot.
It wasn't a plug. It was.
Yeah.
All right, I'm going to ask our moderator a question. So since this is a technology, big technology debate, it says so there. Yeah. What's Intel doing, and where do you guys see it going? And is it in addition to that, have you guys released that speed of light accelerator that you've been working at?
Speed of light accelerator, right after the beam me up Scotty tool. So where do we see it going? I think there are two things that are happening right now. The cost structure of the business in its entirety is changing radically. The ability to get into automated trading or use computer-based technologies and tools, whether it's in a stat arb function, where you are able to take advantage of massive crowdsourced analytics. We heard a great presentation earlier. Or whether it's trying to find new disruptors who are going to lower the barrier to entry, or even the exchanges themselves offering co-located capabilities, plus this nature of co-opetition where one firm has a CEP model to get into the game. That cost structure is changing, but the regulators don't really seem to have their act together, and it's primarily due to a lot of issues. But one of the issues that we see is that the regulatory bodies just do not seem to have any technical competency when compared to the market participants. They just don't get it. And it's really hard to figure out how we can get them to cross that bridge. Because if the underpinnings of the market, whether you are in India or whether you are in Chicago, are going to be based on technology, it helps to have an understanding of what that foundation is capable of doing and how to do it. So that's pretty much where we see it. Arzhang, you get the last question to anybody.
Okay, I actually have to find the exact language here. I had someone email this to me. No, it's not scary that way. Give me 1 second. Okay, so recently there was a meeting at the CFTC where people were trying to put together a definition of what high-frequency trading was, so as to better help regulators and legislators figure out whom they should target. What was interesting was that, well, I'll say the definition first. Essentially, it was a form of automated trading that uses algorithms for decision-making, order initiation, generation, routing, or execution for each individual transaction without human direction, and that the trading uses technology that would minimize response times and rely on high message rates. And this caused, apparently, an enormous amount of consternation amongst some of the non-HFTs who suddenly realized that, oh, when I'm implementing my $4 billion futures trade using this technology, I could be potentially responsible for damaging the market in the same way that I'm accusing HFTs of being, capable of hurting the market. And I kind of felt like it was a moment where they, took the red pill and realized that they're part of the matrix also. So my question is, either, I guess, for John or Larry, what do you think about that type of definition? And should there be a very broad net that targets the technology as something that should be regulated, or like some of the non-HFT participants, should there be an exemption because their holding period is longer?
That definition, you could do one trade a day and just have tons of messages, maybe quite a few resting limit orders that never got filled.
It's obviously far too broad. It doesn't really capture. I mean, you mentioned earlier, HFT was born with Reg NMS, and basically, and that's actually so I think that's actually a net bad, because anything that's a rent-seeking behavior. But there's been, but nonetheless, there's been some good that's come from it. There's been a lot of technology and market techniques that have developed that can be used to stabilize and make markets healthier. I think the regulators were trying to define what is bad HFT, not what is generally HFT, and I think that they should probably try and. It's a difficult definition to make. I mean, one is obvious rent-seeking behavior, taking advantage of a regulation. Another might be a source of trading where the primary driver of profitability is speed rather than the willingness to take inventory or risk. I think they should try again.
No more maker-taker pricing?
Yeah, not all regulation is bad. We're not, ooh, boo, ooh, regulation. But if it costs me money, I don't know. You got to tell me how many trades we can do, and then we're going to, you did 100,000 trades today, so you have to pay a tax. It's not.
Well, I want to thank our panelists to try to get it back on schedule for time, and I want to thank the audience. And then with that, I guess we will wrap to get you guys back up, or did you want to do any Q&A for time?
We have time for just maybe one question if anyone's, they've got a great panel up here. Question here from John.
John Rapp, Telpson and Company. What do our panel predict in 2 years the landscape will look like? How many options exchanges will there be? What is the potential for consolidation of regulators in the United States? And how many firms will be left in business?
On the options question, there'll probably be 25 maybe. And so, obviously a joke within the market because we seem to be adding, 3 every 6 months, right? And then you've heard Tom Klote, who's the CEO of the Toronto Montreal Exchange Group, which is a 53% owner of Box, was interviewed yesterday, and he mentioned that TMX and Box are moving into the stock world. So that should be interesting.
John?
Do we need another stock exchange?
John, do you? Or Arzhang, one of the two?
You go first.
Okay.
Yeah, I mean, I think that what will be interesting is a lot of the things that people have been complaining about or confused about over the last few years are going to become commoditized. And I think you hit a tipping point when Fidelity realizes that they're using HFT technology to implement all their portfolios. And so when those advantages start to get distributed and everyone's become an adopter, then one, the concept of just being profitable based on speed alone will start to disappear. Everyone's going to have the same type of speed. And I think the bigger phenomena is that it's a targeting of a technology advantage that has not yet been disseminated to everyone. And this causes frustration, and this is something people complain about. And if the next phase of that is that automated news processing is done faster by certain people, or that they have faster wires for whatever, I mean, it'll be something different. My guess is that what we currently consider HFT will certainly have to be much more adaptive, and it will fit more into the spectrum of alpha than where it had been, let's say, 2 or 3 years ago, where it really could be an isolated thing.
Sure. Any comments? Larry?
Regulation, I'm probably not the best for answering. Competition, I'm good at that. I think that you're going to have more competition as barrier to entry is lower and lower and lower. You can only get so fast. I got a guy, Quinjin Yu, I don't know if you know in New York. He's at 5 microseconds. You can't get much faster than 5 microseconds. So now you're going to have more players in that, especially if you think from a larger global perspective, these funds that we're doing private equity. I think a lot of money is going to move out of private equity and come into us because there's fewer and fewer and fewer things to chase. These new startup companies, the internet companies you guys are alluding to, we're losing our PhD candidates that are going to Google and Facebook because they can get the back-end payment that they're not getting with us. A lot of the technology companies, they don't need a lot of money to start up and to grow. So if they don't need a lot of money, the VCs, what are they going to do with their money? So I think that industry is going to shrink and our industry is going to expand. As to regulation, who cares?
So there.
Larger number of smaller, very competitive, very nimble, go into any market. Like our firm's tiny. He's at 7, so we're both under 10 employees.
Intel's point of view on this would be that the commoditization of the technology and the commoditization of the cost structure, along with a global boom in brains, will create an enormous amount of new competitors with a much lower cost basis that can eat the bigger guys' lunch. The second thing on regulation, quite frankly, is that the regulators, it's regardless of who's in 1600 Pennsylvania Avenue or who's controlling Congress, it won't get solved anytime soon. But I do think that one thing that will change is that from a trading logistics space, if you will, our point of view is that we think the regulatory framework will shift a little from being almost overly burdensome on exchanges to a more shared burden across the elements. And then last but not least, I think within 2 years, the regulatory bodies will wake up to the fact that building a fully capable, full audit compliance system of every single transaction that is done among all counterparties can be achieved at a very low cost. And the people to teach them that will be the NSA. So with that, I just wanted to say thank you, everybody, and thanks for have a great conference.